this is just the beginning.
Welcome to the Tech M&A Bounce Back virtual event. I'm Dan Primack, business editor at Axios, coming to you from my house in Massachusetts. Big thank you to the law firm Cooley for making this conversation on new deal making and tech M&A possible. And welcome to our audiences on Facebook, YouTube, Twitter, LinkedIn, and Axios.com. On Twitter, be sure to follow us and join in the conversation at Axios and by using the hashtag Axios Events. Over the next 30 minutes, I will be joined by my colleague, Kia Kokliacheva, and together we will unpack the future of the markets and how innovative teams are getting things done. Our first guest is the co-founder and CEO of Slack, Stewart Butterfield. Stewart, welcome to Axios.
Thanks for having me.
So Stewart, let's start here. Let's go back a year and maybe a couple weeks from now. How were, the feeling was that everything was about to collapse, including the economy, and then all of your customers probably and their businesses. Were you panicked going into the pandemic, or was there any part of you who thought this could actually be better for Slack? Not for the country, but for Slack.
I'm not sure if that was a thought or the panic. It was really, with many, many other people, I would say almost every Slack employee, and millions of others. It was a time where everyone was activated. I'm not sure how else to say it, but everyone was looking for ways to contribute, looking for ways to help. Can I donate money? Can I bring food to the hospitals? Can I go help buy masks from China and bring them over? And I think we were really caught up in that. So it wasn't, it was high energy, but I wouldn't call it a panic. And it was pretty clear in the early days that we would play an important role, but it wasn't so much about the business as getting the COVID tracking project up and running and connecting research labs and a whole bunch of other stuff like that.
Could you have foreseen, or did you foresee at the time, that the tech industry as a whole was going to end up having a very good year despite the pandemic getting worse and worse?
Not to the extent that it did, certainly in the beginning. I mean, by halfway through the year, I think it was pretty clear. And I have a relatively new for me way of framing this, because I get asked a lot about, will people go back to offices? Will there be remote work and stuff like that? And I think the real distinction is organizations going digital first. And what I mean by that is executives, leaders will pay as much attention to the digital infrastructure that enables productivity and collaboration as they do to the office spaces, the leases, the conference room build out, the furniture, and kind of all of that. Because obviously that's, the ratio historically has been like this, and I think we're going to see it go like this, so that kind of digital headquarters or digital space that the organization lives is much more important.
The argument, or the conventional wisdom I keep hearing about 2020 vis-a-vis tech, is that the pandemic pulled a lot of trends forward. You mentioned remote work, that being one of them, things that we were already on our way to, and it just accelerated them. Is that a conventional wisdom that you ascribe to also?
Yeah, I think so. I mean, it's not like this stuff was never going to happen otherwise. I think the investment that people started making in digital infrastructure to support the kind of ongoing operations, which, remember, there was a bit of a panic at the beginning. I think that naturally led to a kind of continuation or extension into other digital transformation projects that were, adjacent to the necessary. And all of those are things that would have happened anyway, but now they're happening faster.
So the big news for Slack last year was, of course, the decision to get acquired by Salesforce. Take us back a little bit. What's the first point of contact between you and either Mark or Brett Taylor over there, and the talk of an acquisition first comes up?
Yeah, well, I've known Brett for 15 years or maybe a little bit more than that. And I think that this round of conversations probably initiated earlier in the pandemic, like maybe April or May or something like that. I reached out to him to see about the possibility of Slack acquiring Quip from Salesforce. Now, Quip was a company of which Brett was the CEO, and it was acquired by Salesforce, and now Brett's the COO of Salesforce. And that never really went anywhere, but 6 months later, Brett came back and kind of turned the tables a little bit, and we started talking about Slack being acquired. I mean, the reality is, though, we didn't talk about this as a business consideration or an acquisition at first. It was much more talking about what we expect to happen over the next 5 or 10 years. And 10 years is a little bit sci-fi, but I think 5 years is close enough that you can make strategic decisions around it. And we just see the world in the same way. And this is a way to accelerate our arrival at that point.
What's the main thing about 5 years from now in terms of the kind of the macro, market, I guess you could say, that makes Salesforce and Slack together more powerful than alone?
It's a great question. And I think part of it is, Salesforce propelling Slack to a certain degree. And the traditional means of that happening are there's a product and then there's a much larger organization with a bigger sales force. And that, sales team, is out there selling the product, and that makes a big difference. I think for us, it's also Salesforce's investment in Slack as a platform and this kind of coordination or engagement layer that spans across their different tools. So they obviously bucket most things they do into CRM, but there's Sales Cloud and Marketing Cloud and Service Cloud, and they all serve different functions, and they can be these huge implementations. And coordinating the whole organization around those customer-facing activities is Slack. And the more that's realized, the easier it is for every other software company to really think about how they want their Slack using customers to experience their software and how we can make that better.
Let me ask you a little bit about pricing and how you think about this. Obviously, you guys got a good premium in terms of the Salesforce deal. Shareholders seemed happy. That said, when you signed that deal, your stock, but tech stocks in general, had just been on kind of this hockey stick for quite some time, a brief break at the beginning of the pandemic. How did you kind of get yourself to accept a number, really any number, when I assume somewhere in the back of your mind had to be something like, if we waited 6 months, we could probably get 20, maybe 30% more, or conversely, do it now because in 6 months we might get 20 or 30% less?
Yeah, I think both of those and like kind of every shade in between, and not just me, but our board and executive team. Who knows what kind of outcome is going to get in the future, and it's really difficult to make decisions about what you want to do today based on kind of a guess or a hypothesis about what the market will do 6 months from now, because people can't even predict what the market's going to do like 2 milliseconds from now. The high frequency traders still get things wrong. So it was much more about the kind of the value that we can build over time. And obviously for Slack shareholders, it was a realization of a large portion of the investment. But I'm going to be a pretty big shareholder in Salesforce going forward. And I'm aiming to make that a huge success as well.
Stewart, one thing that's most interesting about you in terms of acquisitions and tech M&A is that this isn't the first time you've done this. You've done this before. And my perception of you after the first time when you sold Flickr to Yahoo was that you were never going to sell a business of yours to a big strategic corporation ever again, because your experience the first time didn't go very well. How did you mentally cross that hurdle this time?
Well, I think part of it is, it's 16 years later, it's a different world. But the big difference is at the time that Flickr was acquired, I think it was 9 of us on the team, and Yahoo was 12,000 employees. Joining Salesforce today, we're 2,600 or 2,700 people. We crossed $1 billion revenue run rate. We are growing billings by 41%. We're in this incredible phase of customer growth, because that's the big result for us over the last year was we added 46,000 net new paid customers compared to 22,000 the year prior. So it's enormous growth there, and that's going to kind of feed the business for the next several years. So it was an exciting time, but we're coming in just a totally different relationship in terms of the power dynamic and what's possible.
Stewart, final question for you. What's your advice to kind of unicorn type CEOs, which you were, privately held companies that are whose phones are nonstop off the hook with SPACs calling them right now, trying to bring them public?
I think you got to think pretty carefully about going public. And we did a direct listing. I've had a lot of friends do traditional IPOs over the last couple of years. I have not been in touch with any CEOs of companies that went out through a SPAC, but I don't think that really matters. So if you were not already planning to go public, if you hadn't already initiated this public company readiness projects and you were already, it was already something that you planned to do, I don't think a SPAC would be a good way to do it. In other words, it shouldn't be you decided to go public because there were SPACs. But if you do want to go public, I think it's an alternative to consider.
Stewart, thank you so much for joining us.
Thank you.
And next we have our View from the Top segment with my colleague, Axios Chief Revenue Officer, Fabricio Drummond. Fabricio, over to you.
Thank you, Dan. It is now my pleasure to bring you a conversation with Jamie Kathleen Lai, partner and co-chair of the M&A group at Cooley. Jamie, welcome to Axios.
It's a pleasure to be here. Thanks for having me, Fabricio.
Oh, thank you. Jamie, let's start talking about M&A transactions and kind of the landscape, looking back to 2020. How did we round out and what are you seeing in 2021?
Well, after a truly tumultuous first half, as you know, the deal market rebounded in truly exceptional fashion. We're now living in one of the most active deal markets in history. Tech deal making in particular, very resilient. It's our serial buyers that have been quick to rebound, looking for strong growth profiles and targets with stable teams and easy to integrate operations. Our sellers, too, with valuation wind at their back, are levering the alternatives of the strong capital markets and exit valuation goals that are stronger than ever. The 2021 outlook is, of course, even more robust with the Q1 numbers that are rolling in now. We see we're outpacing prior quarters in Q3 and Q4 of 2020. And we're really looking to measure the healthy deal markets, particularly with those mid-sized deals where the real action will be at for 2021. I think, Fabricio, and you and I should take a bet and write down who we think the strongest players will be in 2025, because M&A today is truly the foundation laying for the strength of success along the 5-year time horizon. We're obviously watching SPAC volume increase year to date, total more than we saw in 2020. So we're keeping a really strong eye on the SPAC trajectory as well.
Excellent. Jamie, I've been involved in a few M&A transactions myself. I remember in the past, these were mostly in-person meetings, deal teams from both sides, the sell side and buy side negotiating contracts and terms and pushing the deal to the finish line, including celebrations. And then COVID hits us last year. We're in a remote reality now for over a year. How have you seen this impact deal making in this remote reality?
The downside is we all miss the deal room. Of course, in person, there's more rapport building, maybe a little more risk taking, some more creativity, and really those early stages of integration that happen in the room in the deal. So we definitely miss it and look forward to getting back together in the room. That said, I've been really proud of our deal making colleagues. Stewardship has been a top priority, collaborating to ensure that deals get done from not just remote environments, but more volatile environments, more pressure to do things that are really accretive under short time horizons. And it could have been quite different, right? With higher sensitivity and insecurity comes the ability to be sort of scorched earth or winner take all in mentality. And I'm just really proud of the way that the deal making industry has continued to be stewards.
President Biden is nearing his first 100 days with his new administration. What changes do you think we should expect to see, especially in the regulatory space?
So we're all watching very intently to see leadership positions secured in both of the agencies. We do, of course, know that there's bipartisan support for increased headcount and increased budgets. We will be interested to see how agendas get more specific and more formal as the next 100 days unfolds. My personal view from a tech regulatory perspective is that there's a lot more focus probably brought to bear in what we think of as the monopoly-focused mindset than on any individualized deal. That said, as good stewards of deals, those of us on the legal side are ensuring that strong, robust antitrust analysis and strategy is one of the primary things we look at the very outset of a deal to ensure that our strategy is aligned and any individual deal has the highest chances for success.
You mentioned SPACs. There's been certainly a lot of traction in 2021. Over $80 billion in capital has been raised. We're probably close to 400 SPACs now going public. If I'm a CEO thinking about taking my company public via a SPAC, what are the things that I should be thinking about?
I think it's a hot and saucy time in SPAC world, right? And the chance to have a liquidity event without quite as much of sort of the overburdened process of a traditional IPO is very compelling. And so I guess my caution to a particular exec team is to decide if this is the right time for you to go public or not. Are you ready for the increased disclosure scrutiny? Are you ready for activists who will be chomping at the bit as soon as there's more fodder or disruption in the marketplace? Are you really ready to stand up a public company ready institution? And how does that compare to the need for ease to capital markets or a liquidity event?
And maybe just one last thought, Jamie, before we go. What are some of the issues that you're watching for in the market in the next 6 months?
Yeah, these are strange, but such interesting times. There's going to be a very strong push from our large serial buyers, really laying foundation for long-term growth with employee bench strength and and IP competitiveness. In particular, we're looking in that $1 to $3 billion price tag range, which seems very interesting and compelling from a growth strategy perspective. We'll see continued use and creativity around stock-for-stock transactions. Valuations are hot, so stock is key, and buyers are looking to both distinguish themselves and, of course, protect their balance sheet. And last but not least, I think there will be new regulatory scrutiny, not just on the competition side, but also with respect to SPACs. This is a new world with respect to SPAC attendant litigation, and we're watching closely to see some of those first cases hit to take all the learnings we can to support our clients.
Thank you, Jamie, for such an insightful conversation.
It's been a pleasure. Thanks, Fabricio.
Thanks, Cooley, for making this conversation possible. Now over to my colleague, Kia.
Thanks, Fabricio. And I'm Kia Kokolicheva, and I'm the tech and business reporter for Axios, joining from San Francisco in California. And our final guests today are the founding partners at Merus Capital and former VP and Principal of Corporate Development at Google, Salman, Ullah, and Sean Dempsey, joining us from Menlo Park in California. Welcome, guys.
Hi there.
Thanks, Kia, to be here.
Thank you so much for taking the time to be with us and talk about mergers and acquisitions today.
Happy to. It's always a lot to talk about in the world of M&A.
So you guys have a really unique background in that before you started your VC firm, you both worked at Google in corporate development, and then before that, you did a lot of the same stuff at Microsoft. So I'm going to ask you to put on your big tech company hat for a minute. And the first thing I'm really, really curious about is over the last year, folks, especially in DC, have been bringing up antitrust a lot anytime that any kind of M&A, especially in the tech industry, has come up. So we saw that, when Uber was talking to Postmates, we saw that when Grubhub was having different conversations, and lots of senators came out and just had some strong opinions about potential antitrust issues. But at the same time, it didn't seem to really stop the big companies. I mean, Facebook bought Giphy and some other stuff. Everybody else just forged on with their acquisitions. So with that big tech hat on, why do you think none of that noise really had an effect on M&A activity?
Yeah, maybe I'll start, and Salman can add to this. But I think there's a couple of things happening, and I do think we'll actually see a slowdown in M&A from big tech. I think this does have a chilling effect. I think, as you mentioned, there hasn't been so much of that thus far because antitrust enforcement hasn't necessarily changed a whole lot in this country, and that is starting to change potentially. We'll have to see about that. But until we see that, I think companies, if they feel something is truly necessary for them to pursue, they're willing to do that. And we'll see if the Biden administration changes that, the regulatory environment. But I do think with the scrutiny that companies are seeing today, it does have a chilling effect. If you're, let's say, a general manager inside Google, for example, looking at a potential acquisition, the timelines now are just very different than how they used to be in terms of getting something done and the certainty of getting that done in any kind of reasonable time frame. So the internal review, just to get a green light to move forward, and then the expected regulatory review, given the scrutiny that these companies are under, deals are taking, look at Fitbit as an example, over a year to close. And so that's just challenging if you're looking to buy something and not knowing when it's actually going to happen or if it's going to happen. And secondarily, if you're a seller, there's a lack of certainty or a renewed lack of certainty around whether the deal will actually happen. For a seller, it's actually a much more challenging situation. This is really what your future is, whereas big tech can potentially walk away from almost any deal and be okay. For a seller, this is the future. And if I'm in limbo for 6 months or 12 months, not knowing where my business is headed exactly, that's a challenging place to be. So I think we'll see sellers looking for more certainty if possible, or bigger breakup fees, and all that is just friction that I think will lead to some slowdown in at least in a larger M&A.
Yeah, well, I think a lot of the scrutiny is driven by, obviously consumer data privacy issues. And so for the things that are very consumer facing, you're combining corpuses of data around, individual consumers. I think that's going to engender a lot of scrutiny, even hostility in Congress. On the B2B side, it's probably less likely to slow things down. And typically because B2B stuff tends to be a bit more arcane and doesn't really impact individuals as such. And, it's just not as exciting from a, Washington, D.C. perspective, whether, company A buys company B in two obscure industries. No one's really paying much attention. And especially their own constituents aren't paying much attention to that. But if it's privacy related, consumer data related, then yeah, I think that the bar is going to be much higher.
Are you saying that we should be paying attention to these enterprise deals and we haven't, and someone, dropped the ball there?
I think it's a great question. I think in general, tech is it's an area that's very hard to scrutinize because it is tech. It's technical. It requires a lot of education around what's a browser, what's an API, and all the rest of it. And people typically haven't been willing to kind of put in the hours to understand that space. So it's a challenging area to really get into and understand whether which areas should be more tightly scrutinized or regulated. I think the EU is a little bit further ahead in the US in that regard. They've actually put time and effort into understanding what tech is. So same thing may happen in the US.
I think additionally on the B2B side, sorry, I was just going to simply add, I think you see less of the natural monopolies, right, on the B2B side than on the B2C side, where you've got companies that have aggregated demand, right, and that's the nature of today's kind of modern tech monopoly or quasi-monopoly, and you just don't see that same dynamic on the B2B side. So there's, I think, naturally a bit less scrutiny there than we've seen on the consumer side.
One of the interesting things, though, which is kind of interesting, you said that, is that Visa and Plaid, they announced their deal over a year ago, and then after a year of dealing with regulators and being sued to block the acquisition, they just decided to walk away earlier this year. And a lot of the issues were around sort of the bigger market impact of those two companies coming together. Do you think this type of, I don't want to call it meddling, but this type of intervention or just harder look at these, behind the scenes kind of technologies that no one's really paying attention on the consumer side, do you think that could become an actual issue and we start to see have an impact on enterprise tech deals?
I think the short answer is yes. Certainly, as Salman referenced, I think anytime you have, and in the case of Plaid and Visa, you did have some consumer data, consumer financial data that is part of that narrative that I think people are naturally more concerned about, and there'll be more scrutiny over that. So I think we'll start with and see more scrutiny and focus around the consumer side and the truly big tech. But no doubt, if we see stronger enforcement over time, that will trickle down to smaller deals or non-consumer deals. So I think we will see more of the Plaid Visa type of situation.
Mm-hmm. One kind of really unique type of M&A deal is SPACs, special purpose acquisition companies. And they've been exploding in the last year. I'm pretty sure no one predicted that. 2021 is already crazier than all of 2020. How do you guys think about that in terms of in the spectrum of deal making and acquisitions? Is it taking the place of more traditional, company sells to bigger company as opposed to a blank check? How do you think about that overall in the M&A world?
I think in general, it's a great thing for a venture investor, meaning it's another way to get public in addition to a traditional listing or direct listing. So anytime you have another vehicle to take a company public, if it's appropriate for that company, that's a very positive thing. So I think we're fans of SPACs, and we're seeing that in the portfolio right now. And it is, as you say, more of an M&A type of transaction that so happens to result in a company being public at the end of it, but it is much more akin to an M&A transaction going into it. So I think that will be a trend for quite a while. Now, even if the market does become more choppy than it has been, you still have a lot of sponsors out there that are loath to give the money back. They'd much rather get a deal done than have to return the capital. So they'll be looking to do that over the next 12 months or 24 months. And so I think there'll be a lot of activity there. And yes, if you're a private company looking at different options and you think now is a reasonable time to do that, whether it's IPO or traditional M&A, SPAC is certainly a good option to consider.
And then really quick, give me a yes or no. Do you guys think that this bull market and these crazy investments and deals and all the craziness that's been happening is going to keep going this year?
I'll let Salman answer that one.
Yeah, the music always stops. So at some point, when precisely, no one knows, but it will stop. And, that's just the nature of the world we live in.
All right. Well, we're all going to be getting ready for the end of that dance party. Thank you guys so much for taking the time today. This was a great conversation.
Thanks, Kay. It was a pleasure.
Thanks, Kay. I'll be here.
And thank you all for joining us this afternoon for another virtual conversation that has made everyone smarter faster. And thank you to our sponsor, Cooley, for making this event possible. For more info or to sign up for Dan's newsletter, Pro Rata, visit axios.com/newsletters or the Axios app. Thank you all for joining, and we'll see you on axios.com.